Welcome everybody. This is Stephen Miles with Atticus, and I've got Breland Applewhite with TPC. We're here to go through a discussion of the model and calculator that we have built for individual investors, as we get a lot of questions about, hey, as I invest in your renewable energy fund and the credits and depreciation, the cash flow, how does all that work? What does it look like year one? What does it look like over a 5 to 7 year period? What are some of the variances in state taxes and bracket rides and all those things? So we're going to touch on a lot of that today. We've had a lot of advisors ask us to spend some time on this so that as we send out these presentations to clients, they'll understand how this applies to them. So Breland, why don't we talk a little bit about the model, what we've built here, and what it's designed to do at a high level.
Okay. Really, the model was built to take out to individual investors and be able to create a customized investment amount for them. So we can take a look at their income situation, their personal circumstances, and be able to come up with the most efficient investment for them. And by efficient, what we mean is maximizing the investment amount versus the losses and the credits that they're willing to take. In federal tax credit world, you can only offset up to 75% of your passive tax liability. And so what the model is designed to do is find that optimum point based on your income of how many losses you can take versus how many credits you can use to hit that 75%.
Absolutely. Take us through this first page here. I know we have an example of someone who has $1 million in active ordinary income, $250,000 in passive ordinary income, and how does the model calculate that as we look at this initial page in here? Again, we'll go through some more details here in just a minute as we walk through that.
The model was designed to actually go through the bracket ride for an individual. And that becomes incredibly important when you're messing with federal credits that have that limitation, to make sure that you are getting that optimization. So as we'll talk about in other examples, you will see that as the passive income changes and the active income changes, your overall marginal and effective rate are going to fluctuate. And so that model is designed to follow that bracket ride to make sure that we produce the most efficient result. We don't want to overbuy, we don't want to underbuy. We want to try to make sure that we're doing what we're supposed to do. And so utilizing that bracket ride and your individual taxpayer situation is really important when determining how much should you invest.
Right. And just to let everybody know, this model really looks at a couple of different things. Number one, it looks at your sources of active income. It could be ordinary, it could be long-term capital gain, passive. It can look at the same categories. Also, it looks at your tax filing status. If you're single, if you're married, filing jointly, right, there's several other categories. So we can really get this specific. I think now is a decent time to talk about some of the assumptions in here, because if it was all about federal, this would be very, very straightforward. But there are some things that can create some variance at the individual level. So let's just spend a little time talking about that.
And one of the big things that can cause that variance is your state that you pay your taxes in, right? And it's not necessarily just your personal situation. You're looking at a fund that's going to have a portfolio of projects across the country. And each of those is going to have certain state filing requirements and different tax rates. So the overall state benefit that you're going to see when we run through this will fluctuate depending on where you pay your taxes and the projects where we end up across the country with our projects. And so that's really the major variance that you'll see is on the individual state side. Most of anything else from a variance perspective is not really going to change. The federal is what the federal is, but it's just when the state comes into play, each state has their own rules and their own tax rates. So there will be a little bit of a variance there.
Great. So just to recap, the variance on the federal side is really bracket right. If all Correct. Of your money is at the top marginal rate, you're making millions and millions of ordinary dollars, that's going to be pegged out. To the extent that maybe this investment drives you into some of those lower brackets, that would create variance. The state side is really where there'll be total variance. It depends on where the individual lives and what state they live in and where all the projects are all over the country. Probably will be in multiple states.
Will be in multiple states.
And ultimately, there will be benefit derived from that, but it can change based on people's situation.
Correct.
Excellent. Let's spend a little time talking about this particular model, this 1 million in ordinary active income and the 250 in passive ordinary income. And then we're going to look at another model here in a minute where we change those numbers up a little bit. You'll see a little bit of that variance.
Okay. And as far as the year one benefit, what we're looking at is the actual outlay of cash from the investor versus what they're actually going to get back in tax credits and losses for the depreciation in year one. And what you'll see in this example, the investment from the individual will be around $70,000. It'll be about 69.6. And what that's going to do, because of the leverage that we've been able to put into these portfolios and make your dollar work harder for those benefits to actually give you a better result, that's actually going to turn around and give you about $41,000 to $42,000 worth of benefits from depreciation in the cash value of those, and about $42,000 worth of tax credits. Now, one thing that we do want to point out, these are cash flowing assets. And so when you put your tax dollars in it, it is a cash flowing asset. It will produce income. So there is a little bit of income. Year one will be a little bit smaller because of when we come into the projects. But over that 12-month period, it should be around $3,000 to $4,000 of cash flow to you on top of the tax benefits that you're getting. So your overall net benefit year one is going to be around $17,500 on the $70,000 worth of dollars that were otherwise tax dollars that you repurposed and put into a cash flowing asset.
Absolutely. And that's a key point that we like to stress is these dollars are not typical investment dollars that people are looking to look at multiple investments. These are really dollars that are sitting there waiting to go to Uncle Sam in the form of federal and state taxes that we've discussed. And this is an opportunity to use a calculator like this, understand the risk reward paradigm, and repurpose some of those dollars to a renewable energy project and keep, in this example, $17,000.
And what that equates to as a return on your actual dollar invested is you're going to get that dollar back plus 25 cents for every dollar that you put up that was otherwise not your money.
Sounds great. Let's move beyond year one and do a little more year one detail and talk a little bit about, as we dig through this calculation, we give without planning what this particular tax scenario, and with planning what that looks like. A couple of points you might hit in there, Brent.
The main points that you're going to want to pay attention to is the losses and the credits that are actually coming in for you at this point. So what you'll see in the column on the left side of the screen is the no planning. We're going to make our money. We're going to pay the taxes as Uncle Sam wants us to pay. And at the end of the day, in this example of our 1.25 of total aggregate income, we walk away with just shy of $800,000. Okay, so we walk away with, give or take, about 70 to 75% of our money. On the right side, you'll actually see where we're doing planning and we're getting to take some losses and utilize those credits to be able to come in here and decrease our overall liability, but also use those credits to offset some of that liability. And what that ends up leading to is, through that investment of about $69,000, we'll have our losses come through that will reduce that adjusted gross income and taxable income. And then we'll also have a fair amount of credits that are going to come through on that. And what that's going to do is decrease our out of pocket to Uncle Sam at that point. So at the end of the day, our actual cash in hand is a little over 800,000, about 810,000. So that investment at the end of the day that we put up is going to turn around and put $17,000 back in our pocket that we otherwise had going out the door.
Absolutely. Let's pivot beyond year one, because again, what most people do is they focus on year one, which is really good. That's where most of the benefits going to happen. But this is a long-term investment. We have to stay in this investment for at least 5 years so that all the credits cure. They cure at 20% per year. At the end of 5 years, the credits can't be taken away. So we've got to live in that project. We've talked about the cash flow from the project. One of the questions we get around is around recapture. So walk us through this calculation and what we're seeing here on a year-over-year basis. Again, we've looked at year one in extreme detail. This lays things out a little further.
Yeah, and what we've done is really try to show the life cycle, right? There's the tax dollars that are invested in year one, the credits and the losses that are generated. And then over the coming years, between the credits that are, the losses that are generated on the federal side, since we no longer can take 100% bonus as it stands today, some of that depreciation will actually trickle out over the coming years. States, again, we talked to the various, some states follow bonus, some do not. So all states have their different deals, but they're going to have that benefit that's going to trickle out over the coming years. And then we have our cash flow. Again, this is a cash flow producing asset. It is going to produce a fair amount of cash flow from the production of energy that is being produced. And so what this model actually shows is cradle to grave, the beginning, the tax dollars invested, all the way up to the end of it, where we actually plan on selling that project in around year 6 or 7, depending on what we do.
Let's talk a little bit about the cash flow, and we'll move into the recapture. People are going to see some negative cash flow numbers on there. So let's talk about that a little bit as ultimately, because we are showing after-tax investments across the chart here, we have to show after-tax cash flow.
Yeah.
So we'll talk about this a little bit.
And that was really, when you look at a tax incentivized transaction, you really got to look at the tax involved in the transaction in and of itself. I can't speak to the tax benefit that you're getting and then disregard the tax effect of the income that's being produced. And so when you see those negatives, what that is actually the cash flow less the taxes that you will owe from that are being generated from the project. Now, one thing I do want to point out, that while the numbers for the cash flow do look smaller, the reason that is because of the leverage that we put on the project to boost year 1 return, there is a little bit higher leverage. And so the cash flow is actually from the project is actually going to cover the debt. And so that's why the cash flow looks a little bit lower. There's actually significantly more cash flow that is occurring, but through our thought process and our strategy here is to give the investor the best bang for their buck in year 1. And so that's why we've levered it the way that we have, which is generating a little bit less cash flow on the outer years, but it gave us more cash in our pocket to turn around and make those investments that you talked about the beginning, about being able to go to our private equity groups, go to our investment advisors and give them that money to earn money on money that otherwise wasn't ours.
Very good. Let's talk about the last year. Again, y'all projected that in year 7, we can sell anytime after the 5th year, but y'all stretch that out a little bit just to be a little more conservative. Tell us a little bit about recapture on a project like this. What does that look like from a dollar percentage standpoint? And as we built in some conservatism here into the model, what that looks like.
Okay. When it comes to recapture, we have to remember that at the very beginning of this, when we bought it, we were able to take a bunch of tax incentives and tax breaks out of this by depreciating the asset. So when we go to sell it, we are going to be subject to recapture at the end of it. And for the purposes of the model, what we have done is we have all proceeds from that sale, subject to the tiny amount of basis that we have remaining in that project, are subject to ordinary income recapture. And so what that does is we look at that as being very conservative. And our hope is that we would be able to sell the project for more, and we would do some planning on the back end to mitigate that. But for the sake of being conservative, to show that the return is still attractive, we have the recapture happening at the highest federal rate on the back end. As far as another piece of being conservative on the back end is the sale price that we look at selling at, right? The typical tax equity, after tax equity solar farm that's being sold to hedge funds and pension plans and insurance companies is usually trading for the real estate people out there somewhere between a 6 and a 7 cap on exit. The way that we run our models, part of it because of being conservative, and the other part to make sure that the banks are happy with the exit performance and that everything can be done, is we actually run that somewhere between a 9 and 10 cap on exit. And so what we're actually doing is we're discounting that sale price somewhere between 30 and 40% in today's market.
Excellent. And again, that's what we try to do across the board here, is build in a fair amount of conservatism. Anything else to share about the model as people are having calculations done on their income, things that you've seen in the past, questions you're getting from advisors specifically?
And based on the fact that, we built it, we had our first fund launch last year, and we really built this out last year. It's been about 2.5 years of conversations with advisors and making sure that they understand what's going on and the questions that they had. Really, the main thing that advisors and CPAs wanted to see was that individualized model. It's great to be able to say, here's $1 million and $1 million, but they want to be able to go to their client and be able to show them, hey, these are your facts and circumstances, and this is the benefit that it can bring to you. And so as we were building that's really what the advisors wanted to see. And the questions that they had was, what does it look like for my person? What does it look like for my client? And so being able to work with that advisor and that CPA to actually come up with the numbers that they plan on putting on a tax return that they've seen for the first 3 quarters of the year, it helps them as they're actually planning, because there's other planning that goes around to it, around estimated tax payments, other strategies that they're incorporating, and other things that they may be doing in their life. If they built a building recently, if they're going to do a cost seg study, how does that play in? We can build that into the model so that you can have a more holistic look at a tax strategy, as opposed to, oh, here's just one and this is what it's going to do. Who cares what else is happening over here? We wanted to bring all the planning that the CPAs and the advisors are doing for their clients and intertwine that into this strategy to show the overall benefit of their advisory team.
Excellent. We're going to have a couple of other videos come out here soon, but I think it's really important that what you're seeing now is a PDF that we could generate pretty quickly. I think we'll flip to the 5 million model while we just talk about some of the things. So if you just want to flip, I'd love to show that. But this comes out of a much larger model that ultimately, to the extent, as Breland's discussing, hey, I've got some accelerated appreciation I'm doing. Hey, I've done a fair amount of charitable giving. I've bought another piece of equipment that I'm doing that's active in my business that we're going to be taking a huge deduction on. Well, how does all of this affect? And that's another level of planning that we're happy to do, especially as we're working with people's CPAs and other advisors, people with truly complex tax returns, is to build this out in the model, and we can create an output that is truly specific to that individual. Another thing that we'll end up doing is a couple of videos. We're going to have a redacted K1. We're going to do a video around. We will walk through the specifics of that K1. We'll take some screenshots from CCH and walk you through how that goes into the tax software, because you don't get a magic pink certificate with your tax credits on it. That's generated inside the tax software, and we're going to walk through how that works. Again, we believe this is the next year is the year of education. It's the year of people who have never had their clients invest in this type of product and any type of solar investment, to walk them from the beginning of the process all the way through the end when they file the return. Because once somebody's done that a couple of times, we've taught them how to fish. They'll do that over and over and over again. So ultimately, we'll build models like this for investors. We can do this very quickly. If we'll share a link at the end of this video, it'll be on the front page when we send it out, which you can click. You can put in the name of the advisor. You can put in some contact information. We're looking for 4 main types of income to begin with. First of all, your active income, what you're doing every day. You're getting your 1099s, you're getting W-2s for. This is what you do every day. Your active ordinary income, and your active income that you're getting capital gains, maybe things you do every day that are making capital gains.
And one thing that I want to mention while you're talking about that, because we mentioned at the beginning that this is a passive strategy, but one of the things that is very important when you're looking at this is it's all about that bracket ride that we talked about. So it's not just a passive income. Your active income plays a role in determining your overall effective and the marginal tax rate that you end up in, which means the higher that we drive that number and the higher that we can take into consideration all of your income is going to produce a greater benefit. It's going to make sure that you are maximizing that true benefit because you're in a higher federal rate.
Absolutely. And so that is why we ask those questions. Thank you for clarifying that. And then we move into the passive. We want that passive ordinary, passive long-term capital gain. Again, ultimately, this particular fund can help offset capital gain. There's just not enough gain there for it to be worth it. But as your AGI, we'll want to understand that. We get those 4 pieces of information plus what the filing status you have. Are you married, filing jointly, or you're single? We can run a preliminary analysis like this with literally within a minute, get that back out to you. And that can, at least you'll have some documentation where you can say, oh, I have something to start a conversation with here. There's some numbers on the page here that are either compelling or not compelling. And you can move to that next step in the process. So we welcome everyone to that conversation. Again, we're going to have some other educational videos out. Really appreciate Breland spending some time with us here. He is one of our experts that, again, is somebody who really wants to get in technical into the model. If they have very complex income, work through our investor relations. We'll help schedule time with him or one of our other team members and get your calculations done. So thank you all very, very much for your time.
Thanks for having me, Steve.